On the morning of October 3, 2030, the screens in Lower Manhattan glowed red before sunrise. People thought the dollar would die in war, fire, and headlines. They were wrong. The first blast came from the ledger, the balance sheet, the creeping insolvency that turned power into bankruptcy. A man in Dallas opened his retirement app at 6:11 a.m. He owned treasury funds, bank CDs, a fixed annuity, a large checking balance, and 2 luxury condos. He thought he owned safety. In truth, he owned 5 traps built from paper promises. That is how these endings always begin. Not with tanks crossing borders, but with numbers refusing to obey. This day still has flags, speeches, and soldiers. But the cash is gone, the collateral is weak, and the creditors have started counting. At its peak, the dollar empire looked immortal. Gold ones sat in deep vaults beneath heavy doors and colder stone. Carrier groups cut across oceans like moving steel cities. Factories roared, suburbs spread, and neon promised that tomorrow would always be richer. The streets shimmered with confidence. Imported wine sat under bright supermarket lights beside cheap bread and endless plastic abundance. Pensions looked permanent. Mortgages looked civilized. Even debt looked patriotic when it came wrapped in clean paper and official seals. Foreign capitals stacked dollars like reserve bricks. Oil moved in dollars, trade cleared in dollars, and fear itself often ran toward dollars. If you had dollars, you had time. If you had time, you believed you had choices. That was the illusion of majesty. But beneath the surface, the foundation was wrong. The empire had found a narcotic more dangerous than war. It was borrowed comfort. It was spending tomorrow before tomorrow arrived. Debt became the quiet monster in the walls. Every year it asked for more and gave less. It ate discipline first. Then it ate savings. Then it started chewing through sovereignty. The antagonist was never a rival general. It was the bond market with its blank stare and hard arithmetic. It was the auction desk that demanded higher yield. It was the creditor who smiled, then charged 7.8%. The addiction began long before the panic. In August 1971, the gold window slammed shut and the leash was cut. The dollar stopped being a receipt and became a promise. Promises are cheap to print and expensive to keep. At first, nothing looked broken. Stores stayed full, paychecks still cleared, and television kept selling a future made of chrome and convenience. But the balance sheet had changed shape. The nation had traded anchor for velocity. Then came the long seduction. In 1987, the market cracked, and liquidity became the answer. In 1998, another fire started, and easier money smothered it. In 2008, the banking system bled, and trillions were poured over the wound. The lesson learned in every crisis was poisonous. Borrow more, print more. Push the reckoning further down the road. The road kept getting shorter. By March 2020, the machine stopped pretending to be restrained. Trillions appeared in months. Deficits widened like fresh fractures in ice. Asset prices floated higher while the real economy gasped below. Then rates rose. Between 2022 and 2026, financing costs climbed, rollover risk hardened, and interest swallowed whole sections of the budget. Think about the scale of that. A superpower was borrowing to pay for the price of borrowing. The gold was gone. The credit was tightening. The buyers were demanding tribute. That is the rule of 3 in every monetary tragedy. First, confidence weakens. Then, refinancing bites. Then, the exits become political. And that is why the first asset to sell is long-term government bonds. They look stately, almost noble, like marble columns in a national building. But a bond is only a future stream of currency. If the currency is sick, the coupon is sick. In 2027, a 30-year bond paying 3.4% looked reasonable to people craving stability. By 2030, food costs were up 26%, power bills were up 31%, and insurance had become savage. The bonds still paid exactly as promised. That was the horror. Nothing had technically defaulted. The Treasury sent the checks on time, every time, with perfect ceremony. But ceremony does not preserve purchasing power. A long bond during debasement is a prison sentence served in slow motion. The second asset is idle cash in savings accounts, money markets, and certificates of deposit. People call cash king. In a reset, cash becomes a king without an army. It sits on the throne while inflation steals the palace furniture. A woman in Ohio kept $420,000 in cash equivalents because she feared volatility. She avoided stocks, avoided speculation, and avoided risk. That sounded wise in calm years. In reset years, it was like hiding from rain in a drowning basement. The bank statement kept showing familiar numbers. That is how the trap works. Debasement is rarely theatrical at first. It is a silent burglary, measured in groceries, rent, fuel, and the shrinking size of every future plan. The third asset is fixed annuities and fixed pension streams denominated in nominal dollars. They sell certainty, like velvet sells softness. But fixed income inside a melting currency is not certainty. It is embalmed hope. By January 2031, retirees receiving $3,800 a month were still receiving $3,800 a month. The check arrived. The promise stood, but property taxes, medicine, heating, and food no longer respected the old number. That is the cruelty of nominal safety. The contract survives on paper while the life attached to it is amputated in real terms. People say, at least it still pays. Yes, it pays like a candle fights a flood. The fourth asset is large, uninsured bank deposits. Most depositors never study the legal structure because calm times make ignorance feel safe. But above the protected threshold, your money stops being sacred savings. It becomes funding, trapped inside somebody else's wounded institution. When pressure rises, the language changes before the law does. Temporary withdrawal guidance, emergency settlement windows, weekend liquidity protocols. Notice the trick. Every ugly action arrives wearing a clean administrative shirt. On Friday, February 14, 2031, several regional institutions requested emergency support after deposit flight crossed $180 billion in 9 trading days. By Saturday morning, transfer limits were under review. By Sunday night, review had become policy. By Monday, money was still visible but not reachable. People always ask the same question. How can money exist on the screen and not in the hand? Because banking is theater built on confidence. The moment confidence dies, deposits stop being money and become claims. The fifth asset is prestige real estate bought for status, leverage, and imagined appreciation, not farmland, not productive land, not a useful workshop or a modest cash-flowing property. I mean towers, luxury condos, and glossy boxers that only make sense during easy credit. In 2028, a downtown condo cost $1.9 million, carried a floating loan, and bled cash every month. Owners called it an investment. In truth, it was a trophy tied to rates, taxes, insurance, and disappearing buyers. When credit snapped, the trophy became an anchor. That is the hidden rule of wealth traps. Productive assets may endure. Vanity assets suffocate. One gives bread, rent, timber, or output. The other gives you a view, while the carrying costs drain you like an open vein. By spring 2030, the Treasury had to refinance $9.4 trillion within 18 months. Foreign demand was weaker. Domestic banks were already saturated, and pension funds were nursing heavy paper losses. Auctions started clearing at uglier yields. Each percentage point meant hundreds of billions more in future pain. Then oil spiked above $148 a barrel after shipping routes seized up under sanctions and retaliation. Diesel rose, transport rose, food rose, and public anger rose with them. The central bank faced the oldest trap in modern history: print and debase, or tighten and break the state. It tried both. That is what desperate systems do. Rates were held high enough to crush weak borrowers, yet liquidity facilities multiplied behind the curtain. Official restraint on the front stage. Emergency money in the basement. The smoking gun came in a closed meeting on June 22, 2031. Treasury officials, central bankers, and major bank executives gathered around a polished table under soft yellow light. The document was called the National Stabilization Liquidity Directive. It sounded technical. It was foreclosure, dressed as policy. The brutal reality was simple. Someone had to absorb the losses. Taxpayers were tapped out, buyers were exhausted, and bondholders demanded protection. So the burden moved toward depositors, pensioners, and anyone locked into nominal dollars. No one said, "We are liquidating the middle class." They never say it that way. They said, "We need orderly burden sharing." They said, "Temporary conversion mechanisms may be necessary." In plain language, that meant your claims would save the system that had already failed you. One official asked how long restrictions would last. Another replied that restrictions would remain until confidence normalized. Everyone in the room understood the translation. Confidence would return only after enough private pain had recapitalized public weakness. That weekend became the hinge. Treasury settlement windows widened, withdrawal thresholds narrowed, and retirement distributions faced emergency reporting delays. Mortgage lenders froze. Refinances, insurers repriced overnight. The country discovered that liquidity is not the same as wealth. Then the default arrived. Though they refused to call it default, checks still cleared in nominal terms, but value no longer did. The money had not vanished mathematically, it had vanished economically. That distinction destroyed millions. Bread got dearer. Heat got meaner. Wages lagged. Pride collapsed faster than markets did. You could see it in the grocery line, in the pawn shop, in the eyes of people selling wedding gold for utility cash. This is where the old sentence returns with fresh blood on it. Sovereignty is solvency. The moment a nation cannot finance itself without punishing its own savers, its freedom, the anthem remains. The choices do not. Parents stopped talking about college and started talking about groceries. Retirees canceled medicine before they canceled streaming subscriptions, because humiliation arrives in layers. Small businesses laid off staff, not from malice, but from arithmetic. The reset was not one event. It was a season of amputations. Long bonds were crushed by inflation and repricing. Cash savers would dissolve slowly. Then suddenly, fixed annuities kept paying numbers that bought less each quarter. Large deposits were fenced in place. Luxury property owners discovered that prestige cannot make a loan payment. The social cost was not abstract. It was colder apartments, longer commutes, broken marriages, delayed funerals, and adult children moving home with their own children. Entire biographies were rewritten by the price of money. That is what a reset really edits. You could trace every wound back to the balance sheet not to speeches, not to campaign slogans, not even to ideology. The ledger had decided that promises exceeded resources, and the difference had to be taken from somewhere. It always comes from the careful first. The reckless are often already broke. The connected hedge, the nimble move, the disciplined saver, the loyal pensioner, the obedient depositor, they are the ones left standing under the... And then came the generational bill. New austerity packages rolled through 2032, 2034 and 2037. Taxes rose, benefits thinned. Public assets were sold under the language of modernization, though it felt more like a liquidation sale under fluorescent lights. The final reconstruction bond from that crisis was not retired until 2054. Let that year sink in. Children who watched their parents panic in 2031 were middle-aged before the last formal scar cleared. One monetary mistake had eaten nearly a quarter century. Even then, the memory stayed in family behavior. Grandmothers hid cash in walls. Fathers distrusted pensions. Mothers bought useful land instead of polished paper. A generation raised on apps learned the oldest lesson in economics. If you cannot touch the value, you may not own it. This is why history matters more than optimism. History is the autopsy report. It does not care about slogans, parties, or patriotic branding. It asks one rude question: who had the cash, who had the gold, and who got trapped inside the promise? So, if you are holding long-term government bonds, huge idle cash piles, fixed annuities, oversized uninsured deposits, or prestige property drowning in leverage, study the pattern. Do it before the doors narrow. Do it before policy language turns soft and murderous. Do it while choice still exists. Because resets do not announce themselves honestly. They arrive as stability measures, temporary windows, and emergency support operations. They flatter you while they extract from you. They tell you the system is being saved. What they mean is, your balance sheet is being volunteered. And that is the lesson under every empire, every currency, and every polished age of false permanence. Power is not what a nation says. Power is what it can fund without eating its own future. Once that line is crossed, majesty becomes accounting. If you want to stay ahead of people who still think history is driven by speeches alone, subscribe now. This channel follows the money, the ledgers, and the hidden traps before they become headlines. Because the people who survive the next reset will not be the loudest. They will be the ones who saw the numbers early.